to Spread Trading for Beginners. Katie, I feel bad because I always bring you on for segments like these, and you're like, Frank, I know I've been knowing about spread trading for forever, but we bring you on because you are a pro at trading futures spreads. And so let's start with, we'll get to how you can actually put on a spread. And we're looking at equities here today, but why don't you start by simply defining for people what a spread trade in futures are. And we've got the two characters, which is, the small stocks market and the small technology, just two different equity index futures. What is a spread in your mind, especially in the futures derivatives world?
Beautiful. Well, I'm just going to compliment you and say that I just love the way that you set up slides, because you are super good at just like not bogging things down with text and bullets and too much information. And I just love that you're going right to the point here, by just saying spreads are the difference between two markets. And then for me to like kind of add on to that, the thing that I think about if I'm talking about spread trading is, are these two markets possibly correlated to one another, or has that correlation broken down? And therefore, it's essentially just like another, for lack of a better phrase that I use all the time, but like another trading tool in my toolbox to keep me engaged in times of either low volatility or in times of just opportunities that like I might not have thought about before, where I don't want to necessarily put like all my eggs into one specific product.
Exactly right. And it's funny. I was on with our mutual friend, Mikey Butler, on Monday talking about spreads, and the way that he thought about it was, we talked about it for a little bit, was in terms of like two teams playing each other. And you make a very good point that like, if the markets aren't correlated, then I'm trading the spread between essentially like a team that's playing baseball and a team that's playing football. And it's like, I shouldn't be trading the Chicago Cubs against the, Indianapolis Colts. They're not playing the same sport. Here in the equities world, we have two markets that are stocks. And actually, the small stocks has 75 stocks. The small tech has 60 tech stocks. There's overlap to the tune of like, I think like 5 to 10 names between those two different indices here. So two different teams, same sport. And essentially what we're trading in the spread is the difference between their prices. It's similar to like an age old one is like Coca-Cola against Pepsi.
Right.
Some years Pepsi is doing better than Coke. Other years it's the other way around. This year you've seen the small stocks, which has energies and financials and industrials in it, greatly outperforming technology stocks. And you see this spread market, which is now its own thing. It's this one line that is just the difference between these two charts. It's its own market now. It's simply the difference between those two things, and it becomes its own unique trade opportunity, right?
Yeah, exactly. And I wish we had kind of talked about this sooner. And the one thing that has worked out for me in the last day or so is that I bought SM75 yesterday. And now we've actually seen a little bit of a bounce in there. But had I known, I would have maybe even coupled it with the sticks component of it to set us up for this segment even further. But yeah, clearly like a price extreme. And again, because we're talking about related markets that do have a little bit of overlap, it's a great way, again, to maybe extend your duration, hedge your risk a little bit, and trade something that's not just like an outright idea.
Absolutely. And so going back to that sports analogy a little bit more, it's like, all right, we've got two teams. They're playing the same sport. They're hopefully in the same game here. And it's like, right, like the small stocks is the Cubs and the tech is the Brewers, and the Cubs have just been lighting them up. Like they're up 15 runs. And so the spread has expanded there. And if you're going to buy this spread, you're going to buy the SM75, sell the sticks. You're buying the one that's outperforming, selling the underperformer. You're expecting that spread to continue. You're saying, oh, I'm buying these Cubs. They're going to lay it on them even thicker in the future. Now, if you're like us, which is, contrarians most times, it's like, okay, I don't think it's sustainable. The Cubs putting up 15 runs in the first inning. I think there's going to be a mean reversion here. They're going to come back a little bit, and that would be selling this spread, this outlier. And maybe you can finish off this segment, and selling the spread is selling that front part of it. buying the back part of it. In this case, it would be selling the SM75, buying the sticks, which actually today is at a new extreme. And I just put in my portfolio this morning. And maybe, Katie, you can finish up with how mean reversion, how it translates to, as an idea, to some of these spreads. When you're talking about, equities, they don't mean revert, right? The S&P a decade ago was 2,000. A couple of years ago it was 3,000. Now it's 4,000. No mean reversion there. But relationships, they can mean revert, especially when you're looking at the stock market at large relative to tech here.
Yeah, and I love this because I'm glad that you added in what I'm calling like the normal times, like right when we were in 2018 and 2019, where you can kind of see it actually is very closely kind of floating to that historical mean. And then, of course, with the pandemic and all the uncertainty that we were seeing, that relationship kind of broke down. And since then, it's broken down even further. And now that we've had about 2 years of really significant, in my eyes, breakdowns, so to speak, it's like, how much longer can this last? Is this just sustainable? And that's why, yes, as you said, as contrarians, we would probably play the short spread here.
Absolutely right. Yeah, you talk about great, recent cases of mean reversion in these markets. The pandemic hits, and you can see here in this chart, this early part of 2020, pandemic hits, and tech takes off relative to the rest of the stock market, and that's how you see the spread get absolutely hammered. I mean, just a couple of years ago, we were selling tech and buying the rest of the stock market. It came back in line to about the mean, and now it's gone the other way. And so that's how mean reversion works. That's how you can apply it to spreads. We also do it right now. We've been looking at that 2-year versus 10-year spread that's gotten to an extreme the other way. It's the same basic idea of mean reversion, but applying it to spreads. And at the end of the day, when you are trading spreads in here, you're just taking opposing positions in two different markets here today, selling that small stocks, buying the small tech, not caring if stocks go up or down in general, but that this relationship comes back to its mean.